Welcome back. Earlier today was reported the CPI Consumer Price Index rose at the slowest rate in about 2 years, which has very significant implications for our Federal Reserve meeting coming up. CPI 0.1 versus 0.4, excluding food and energy, was in line year over year. 4.0 versus 4.9, that's much lower. Year over year, excluding food and energy, the core CPI 5.3 versus 5.5. Some analysts estimate a nearly 100% chance the Federal Reserve will not raise interest rates. It's going to be very, very interesting to see the markets in the next couple of days. Here we see the blue histogram bars show us the standard CPI that we know. The dotted black line is core CPI, again, that excludes food and energy, and that's strong. That rises. But the green line, that's CPI, specifically food, well, it's also rising. But the red line, CPI Energy, decreasing rapidly. This is the CPI. The green line is food. The orange histogram bars are core CPI versus a standard at blue. That's very much, following each other up the ladder, so to speak. But the energy sector of CPI really falling to the downside. This is CPI versus core CPI. CPI is red, core CPI is white. And again, we see the white line is rising faster than the red line. The white line, again, does not include energy and food, the more volatile components of this market. Now, tomorrow we also get PPI, Producer Price Index. The blue area chart is CPI. The green area chart is PPI. That's what the prices that the producers pay. And the red line is CPI versus PPI. Essentially, it's a comparison between the prices that we consumers pay and the prices that producers pay. These two indices tend to stay, very closely linked. It is thought that if prices rise for the producer, they'll pass on the extra cost to the consumer, and vice versa. With lower prices as well, we see CPI is rising a little bit faster than PPI is. Maybe we'll see an increase, but certainly I don't think that we're going to see that in terms of the energy sector. That really is dragging down. And for those of us that hope the Federal Reserve will not raise interest rates, we have energy prices to thank for that. Now, getting to the bond market, we're seeing a new pattern develop, same as last week. The very short-term 1-month T-bill, 2-month, 3 and 4 month treasuries are all down. The biggest increase in yield we're seeing is in the middle of the range, 2, 3, 5, and 7-year maturities. That's where the capital is moving out of. Yields rise. It means traders are selling those bonds. Yields also reflect the expectation of higher, lower interest rates. The very short-term end of the curve, the 1, 2, 3 month treasury bills, that reflects the immediate expectation for the future. Well, obviously, the immediate expectation for the future, based on today's inflation report, is the Federal Reserve is much less likely to raise interest rates. And that's why we're seeing yields move down. My best guess is we're seeing yields rise in the medium term, 2, 3, 5-year maturities, because it's thought, hey, if we see lower interest rates maybe closer into the future, or at least if we see that the interest rate hikes are coming to the end, well, over the long term, that bodes well for the economy. The economy likes low interest rates. Low interest rates are better for those of us that want to invest in companies, etc. So it's a positive. It's a net positive for the economy if we think that the higher interest rates are over, or at least we're not going to see interest rates any higher than we are now. Short term, lower yields. Medium term, better news. This is where current U.S. Treasuries stand. The 1-month T-bills at a 5.19, 2-month at a 5.24. Again, the highest yields we see now, amazingly, 3, 4, 6 months. But the 2, 3, 5, 7-year yields are rising. This is a 1-month change, and this is what's happened over the past month. 2, 3, 5-year yields up 14, 15%. The 1-month Treasury bill, down 7%. That shows us, the 1 month shows us the expectation as far as future interest rate hikes. This is the 1 month progression in bonds. Notice for the first time in quite a while something very interesting. The black dotted line, the 1 month T-bill, is really kind of quiet. The 1 year, it's starting to poke its head up a little bit, but the biggest move we see, the yellow line, that's the 3 year. The green line, that is the 20 year. The red dotted line, that's the 10 year. The white solid line, that's a 30 year. We're starting to see the medium and even longer term maturities start to rise. And then, of course, the 2 year, which I think is real, that's the real notable change over here, is the 2 year Treasury bond, now to 467. Go back to the beginning of June, we're at 433. That's 30 basis points. That's not an inconsequential rise as far as yield is concerned. The blue area chart in the background, by the way, is the stock market. We're going to talk about that in a minute. Interesting development in stocks, to say the least. This is the 10 years in pink. The red line is the 1 year, and the black line is the Treasury bill. Now, going back to late April, we saw the T-bills really sell off. And again, if you remember that time, there was the expectation that the Federal Reserve was ending the interest rate hikes. That turned around as a result of some numbers. And then we saw the T-bills off to the races. Well, now that has reversed. Remember that day not too long ago, May 26, 602 yields on the 1 month Treasuries. But now they're back down to 519. And then notice what's going up, the 10 year. We're starting to see this gap between the red line, the 1 year, and the pink line, the 10 year, that's starting to contract. Not a tremendous amount, but enough that we should make a note. The reason being is that because we have this inverted bond market, which currently sits around a 140 basis point inversion, where the red line, the 1 year, is above the 10 year. But at the end of every inverted bond cycle that we've seen in the year 2000 and 2007, what has happened is this contraction has this inverted bond market has contracted. In the past, what has happened, and this is really the question, in the past what has happened is the short-term yields have gone down and crossed back below the longer-term yields. This is, for example, in the year 2000, we had the red line, that's the 1 year, cross down below the black line, the 10 year. Will that be the case? Or will the 10 year rise above and cross above the 1 year? If that happens, I think we're in uncharted territory, because I don't see that pattern occurring anytime in recent history. That will be very interesting to see. So we really want to watch the direction and the velocity of the 1 year and the 10 year. The question is, again, does a 1 year cross below the 10 year, or does a 10 year cross above the 1 year? I think that will really determine the future of our markets. Now, finally, in regards to markets, this is where the stock market stands. Now, these are the 4 different majorly traded and tracked indices. The red line is the Dow Jones Industrial Average. That's the 30 largest stocks like Boeing and Home Depot. The purple line is the S&P 500. That's 500 of the largest market capitalization stocks that we have. The green line is a NASDAQ that's heavily weighted towards technology. The Russell 2000 is yellow. That's small cap stocks, small companies. Now, the reason why we're watching this, and just to give you an idea of what we're looking at here, the zero axis on the top left-hand side, every one of these indices is ranked in terms of their recent trading history. If it's ranked at 0 or 1, it means it's literally at the top of the 52-week range. It's trading at the highest price we've seen in the past year. Well, and if it's below, if it's down near the 400 level, it means it's trading at the bottom of the 52-week range. But you'll notice what's happening. This is the point. All the lines are contracting. The Russell 2000 is ranked at 43. That means it's only 43 days off of the 52-week high. The red line, the Dow, is at 9. The green and the purple, the NASDAQ and the S&P 500, are literally at their 52-week highs. We've reached a convergence where all the stock markets are agreeing. We've seen this in the past. We saw in the year 2000, we saw a very tight range between all four indices, the NASDAQ in black, Russell in red, blue is a Dow, and purple is S&P. And when we reach a level of agreement, usually big moves follow. But for the time being, we're not saying that the market's going to turn today or tomorrow. For the time being, all stocks are agreeing. Now, there is a contrarian opinion out there that says if everybody's looking in one direction, we should look in the other. But be careful, because if everyone's looking in the same direction, usually that market will continue in that direction for some time. And this development, this convergence we've seen is brand new. Take a look at the year 2007. The blacks, Russell, and the rest of the markets are really, that's October 07. All the markets reached this convergence. This is where the current spreads sit. And by the way, the gray histogram bars on the bottom, that shows us a spread between the various markets. We're at historic lows in the spreads. The red line is a Dow, the yellow is a Russell. The reason why I pick these two indices in particular is because they usually, kind of diverge the most. The Dow Jones Industrial Average are the 30 largest stocks that represent the U.S. economy. McDonald's, Home Depot, Boeing, things of that nature. The Russell 2000 is the opposite. And we notice going back to April, May of this year, the Russell is very weak. Remember those small cap stocks like Silicon Valley Bank? That really dragged the Russell down. But for the time being, all stocks, it seems like, are going up. Now, I'm sure you've noticed that in the past, in the year 2000, when the stocks reached a consensus near the high, they then turned to the downside. The same holds true in 2007. Will history repeat itself? Well, that's for us to decide, and that's for the markets, to tell us. But that's where we are. And very interesting that we're reaching what many believe to be the end of the interest rate tightening cycle. Today's weaker than expected CPI certainly does bode in that direction. So it'll be very, very interesting to see the PPI, Federal Reserve interest rate decision, and subsequent market reaction. So we're going to be here watching these indicators and charts very closely. We hope this has been helpful. We look forward to seeing you back soon.